Assalamualaikum, my name is Dayang Farah binti ABDUL HALIM from group MGT6465G2. In this video, I will present our thesis titled The Impacts of Interest Rate, Consumer Price Index and Employment Rate towards stock traded based on percentage of GDP among Asia Pacific countries includes Malaysia, Singapore, Philippines, Japan and China. In this video, I will present all 5 chapters. Chapter 1 is Introduction. Let's start with the background of the study. Stock markets are vital indicators of economic health and tools for economic expansions, as they provide a platform for enterprise to obtain funding and for investors to utilize resources effectively. Japan and China chosen among the study's focus countries, as these countries has major global economies with significant contributions to global GDP. As for Malaysia, Singapore and Philippines, these countries are smaller in scale but crucial to the regional economy, and each has unique economic structures and market behaviors. That's why this study focuses on these 5 countries. This study is significant as investors seek diversification to mitigate risk and increase profits. The varied economic structure and stages of development in these nations provide unique diversification opportunities. It is believed that 3 variables have significant impact towards stock markets. Interest rates is an example because of different monetary policies in China and Japan which affect economic growth and inflation, affecting their stock markets. Then CPI, which used to measure inflation. For example, low inflation in Singapore supports robust monetary policies. Meanwhile, higher inflation in the Philippines highlights economic challenges and stock market responses. Last but not least, employment rates. Japan's experience with currency strength and its export-driven economy provides insight into managing employment rate volatility and its impact on stock markets. Thus, understanding these economic indicators is crucial for forecasting economic trends and making informed investment decisions in these diverse markets. This study has 3 objectives. First is to examine how changes in interest rate influence stock market performance among the selected countries, then to analyze the effect of CPI fluctuation on stock trading volumes and price movement during periods of high inflation. Lastly, to investigate whether the employment rate has a significant relationship with the stock market among the selected countries. In order to achieve these 3 objectives, at the end of the study, 3 research questions must be answered. First, how do changes in interest rate influence stock market performance among the selected countries? Second, what is the effect of consumer price index fluctuation on stock trading volumes and price movement during the high inflation? Third, does employment rate have a significant relationship towards the stock market among the selected countries? If this study can answer these 3 questions, then this study can be considered success. Next part for chapter 2 is the empirical studies of each variables include stock traded, interest rate, CPI and employment rate. First, stock traded. The stock market facilitates the exchange of stock between sellers and buyers, allowing public trading of company shares. It operates digitally, providing a platform for real-time transaction. Stock markets are essential to a nation's economy, influencing financial infrastructure and investors' confidence. The proportion of stock traded as a percentage of GDP is a crucial indicator of market development, reflecting economic activity and potential growth. High ratios suggest a robust financial system and significant economic integration, as seen in developed economies, whereas lower ratios in emerging economies indicating less mature markets that evolve with economic growth and reforms. And then interest rate. The real interest rate adjusted for inflation is a crucial factor in financial and macroeconomic analysis, reflecting the true cost of borrowing and the real yield on investment. It plays a pivotal role in monetary policy, influencing economic activity. Past research indicates a strong relationship between interest rate and inflation, where changes in interest rates are used to control inflation. Real interest rates impact stock markets by affecting borrowing costs and investment returns. Lower interest rates generally boost stock market by reducing borrowing costs and increasing corporate profitability, while higher rates can dampen market performance. After that, Consumer Price Index (CPI). The CPI measures the average change over time in prices paid by urban consumers for a market basket of goods and services, serving as a primary indicator of inflation. It directly impacts purchasing power and the cost of living, with rising CPI indicating inflation. The relationship between CPI and GDP highlights how inflation can affect economic growth. In the stock market, moderate inflation, as indicated by a stable CPI, is often associated with positive economic growth and higher stock prices, while hyperinflation or deflation can distort economic decision-making and reduce investment, negatively impacting stock market performance. Last but not least, employment rate. The employment rate represents the percentage of the labor force that is employed and is a key indicator of economic health. High employment rates suggest strong economic activity leading to increased consumer spending and economic growth. Empirical study shows a positive relationship between employment rates and stock trading, which is higher employment rates lead to increased disposable incomes, boosting corporate profits and investors' confidence, which drives up stock prices. Conversely, rising unemployment can signal economic downturns, reducing investor confidence and leading to lower stock prices and trading volumes. Now we enter chapter 3 and 4 where the test started. The empiricals used in this research is shown above, whereby IR represents interest rate, CPI represents consumer price index, ER represents employment rate, while EIT represents the error term. This is the research flow for the panel data, which I will present next along with the results of each test. The research data is collected from worldbank.com as it is a trusted resource platform. First step is descriptive analysis, which done for each variables. Descriptive analysis summarizes key features of a dataset such as distribution, central tendency, and variability. After applying a log transformations to the variables, the statistics are shown as the table above. To conclude, the statistics of each variables are normal except for interest rate, as its skewness and kurtosis is highly skewed and highly leptocurtic, respectively. Next test is unit root test. The unit root test is a statistical method used to determine whether a time series variable is non-stationary and possesses a unit root, indicating that its statistical properties such as mean, variance, and autocorrelation are not constant over time. For stock traded, the p-value is less than 0.05, leads to rejecting the null hypothesis of unit roots, confirming that the data is stationary and suitable for time series analysis without the need for differencing. The interest rate data also rejects the null hypothesis with a p-value of 0.0004, suggesting that the data is stationary, exhibits no time-dependent patterns, and can be analyzed as is. Conversely, the consumer price index CPI has a p-value greater than 0.05, indicating non-stationarity. This means the CPI data's statistical properties change over time, necessitating transformation or differencing for reliable time series analysis. Lastly, the employment rate data, with a p-value significantly lower than 0.05, confirms stationarity, making it appropriate for further analysis without additional differencing. Then correlation matrix. Correlation matrix is a table that shows the correlation coefficients between pairs of variables in a dataset. Each cell in the matrix represents the strength and direction of the linear relationship between two variables, which value ranging from -1 to 1. A value near 1 indicates a strong positive relationship where variables move in the same direction, while a value near -1 indicates a strong negative relationship where variables move in opposite directions. A value around 0 suggests little to no linear relationship between the variables. Above is the correlation metric result. Based on it, the correlation metric reveals that stock traded is most closely related to employment rate and CPI, with interest rates showing weak correlations across all variables. Then static panel analysis, which employed to examine data from multiple entities such as countries or firms over time, aiming to identify the most appropriate regression model. Key tests used in this analysis include the VPLM test, which determines whether a random effect model is preferable to a pooled ordinary least squares (OLS) model by checking if individual differences are significant. As shown in the table above, the BPLM test is below than 0.05. Thus, the test is continued to Hausman test. The Hausman test assesses endogeneity, by comparing the results of random effects and fixed effects model to ensure unbiased estimates. The Hausman test was used to decide whether a fixed effects model FEM or a random effects model REM for the panel data analysis. With a p-value of 0.8, which is greater than 0.05, we failed to reject the null hypothesis, indicating that the REM is more appropriate. After that, the econometric issues were tested to ensure the robustness of the model. First, multicollinearity, which occurs when the independent variables are highly correlated, was assessed using the variance inflation factor VIF. The results indicated no multicollinearity problems as all VIF values were well below the critical threshold of 10. This suggests that each variable provides distinct information without inflating the variance of the coefficients estimates. Second, heteroscedasticity, which refers to non-constant variance of residuals across observations, was tested using the Medifat-Wald test. The test statistic p-value below than 0.05 indicating a heteroscedasticity problem. Third, serial correlation, where residuals from one time period are correlated with those from previous periods, were examined using the Waldreich test. The test statistic resulted a p-value of 0.04, suggesting evidence of first-order autocorrelation. Thus, as the model suffered from both heteroscedasticity and serial correlation, cluster by-code command used as treatment of econometric problem. Next is the hypothesis testing part. Each variable has the same hypothesis, whereby hypothesis null is the independent variable has insignificant effect on stock traded as a percentage of GDP, and the hypothesis alternative is the independent variable has a significant effect on stock traded as a percentage of GDP. So, first variable is interest rate. Based on the result, the p-value of the interest rate in stock traded is more than the significant level, which means it failed to reject the null hypothesis with a 0.01 confidence level respectively. Thus, it can be inferred that the interest rate has insignificant effect on stock traded. Meanwhile, as for the CPI, the p-value of CPI for stock traded is less than significant level, and it indicates that inflation rate has rejected the null hypothesis, which means CPI has significant effect on stock traded. As for employment rate, same case with the interest rate, the null hypothesis for the employment rate is failed to be rejected, and concludes that this variable has insignificant effect on the stock traded as the percentage of GDP, since the p-value of the coefficients of these variables are more than the significant level. Last chapter is chapter 5, conclusion and recommendation. In conclusion, this research investigates the impacts of interest rates, consumer price index, and employment rates on stock traded as a percentage of GDP in Malaysia, Singapore, Philippines, Japan, and China. By analyzing how these economic indicators influence stock market performance, the study aims to offer insight into economic well-being and future growth prospects of these countries. The research found that interest rate fluctuations have an insignificant effect on stock market performance in these nations, aligning with the AMH, which suggests that stock prices already reflect all available information. Conversely, CPI changes significantly impact stock trading volumes and price movement, especially during periods of high inflation. Consistent with the future effect theory, employment rates, however, do not show a significant link with a stock market activity, highlighting the complexity of investors' behavior and the potential influence of other factors such as corporate earnings and global economic conditions. These findings provide valuable insight for investors and policymakers in understanding the economic dynamic shaping stock market behaviors in the Asia-Pacific region. As for recommendation, future research on the effect of interest rates, CPI, and employment rates on stock trading in Asia-Pacific countries should employ advanced economic models like vector autoregression (VAR) and structural equation modeling (SEM) to uncover complex relationships and quantify their impacts, including the effects of external shocks such as pandemics, is crucial for understanding disruption in market behavior. Qualitative methods such as expert interviews and case studies should complement quantitative analysis to provide deeper insight into market sentiment and investor behavior. Long-term analysis considering historical trends and future economic shifts like digital transformation is essential for robust findings. Researchers should integrate advanced technologies such as AI and machine learning to enhance predictive accuracy and disseminate findings through accessible platforms and interdisciplinary collaboration to improve decision-making and economic resilience in the Asia-Pacific region. That's all from me. Thank you.